In this video, I'm going to consider how tax regulations might affect transfer prices, and I'm using problem 1548 as an example. So this company has two operating divisions that operate semi-autonomous. We have Adams Division, which is located in the US, makes this special component that becomes an input to Butte Division, which is located in England. Adams does use its idle capacity to produce the component, but it also has a domestic market price for this component of $12. Its variable costs for the component are $5 per unit. The US tax rate, where again Adams, the manufacturer, is located, is 40%. Keep in mind, this is only a component for Butte Division. They have some additional costs other than what Adams would charge them. For example, they have a $3 shipping fee. It's coming from the US to England. The component becomes part of an assembled product. There's an additional cost of $2 to produce and sell, and the selling price that Butte charges for the final item is $23. Butte could purchase the component from a supplier in England for $10 per unit. The English tax rate is 70%, and they do mention that English tax law does say, hey, for transfer prices, it's completely acceptable whether you use the variable cost of $5 or you use the typical market price of the manufacturer, which would have been $12 for Adams. They accept either one. Our first situation is, let's assume that the transfer price is the variable cost of $5. And I will note, in an idle situation where they have idle capacity, if we go back to original rule, that would have been what we would have typically expected to have been charged. But we want to understand if operating in completely different regions and having completely different tax rates will affect the normal rules. So I'm going to calculate the profit of both divisions individually. For Adams division, it's pretty easy. If they charge $5 for the component and their costs are $5, then they make no profit. So I don't need to figure out taxes. They're not making profit. On the other hand, for Butte division, we see, if we go back up here, they sell the final item for $23, and I need to subtract out any costs. I'm going to do this before tax first. Well, their costs would include the $5 transfer price, if that's the transfer price, $3 for a shipping fee, an additional $2 unrelated to that particular component. So initially, profit would, before tax profit would be $13. Recall, though, that the English tax rate is 70%. So here I'm taking 100% minus 70%. I'm saying what's left over, that's only 30% of the $13, which is $3.90. So that's their after-tax profit. In part two, we're saying, what if the transfer price was the typical market price that Adams can use selling this component to others, which is $12? Again, you'll say, that's not what we should use if there's idle capacity, so just bear with me on this. For Adams division, now they're going to make $12. The cost to them before considering taxes is $5, so their before tax profit is $7. I'm multiplying it times the difference between 100% and the tax rate of 40%. I'm saying 60% is what they're going to net. So their after-tax profit for Adams would be $4.20. Obviously, Butte's going to be impacted. Again, original $23 selling price. This time, though, instead of the transfer costs being $5, it's going to be $12, but we still have the shipping fee of $3. We still have the additional cost of $2. The before tax profit is going to be $6. Again, times the difference between 100% and the English tax rate of 70%. Again, they're only netting 30%. So the profit for Butte in this situation is going to be much smaller, $3.90 here, $1.80 here. So I want to consider these overall. If I add these two together in situation A with the transfer price of being $5, the company overall has an overall profit of $3.90. In the second situation, which flies in the face of our general rule of if we're at capacity, normally we charge variable cost instead of market price, the profitability is the $4.20 for Adam, $1.80 for Butte, for a $6 total. So in this situation, because of much varying tax rates, we're not going to follow the normal rule, and we're actually going to use the market price, and the company overall will get a profit of $6.